Namaste everyone, welcome to our YouTube channel, The Money Master. I am Pooja Sharma. If you have been following news regularly for the past 1 year, then you would have noticed two constant headlines. One about the Sensex reaching new historic levels every month, and the other about new startups getting funded from venture capital fund. In today's video, we are going to see how there is a correlation between these two events and how the central bank can bring an end to this cycle of high capital infusion into startups. Let's get started. Every other day, we hear so-and-so company raised $1 million in Seed A or Seed Z funding. But have you ever wondered why there is this sudden rise in the interest of VCs in funding startups at such a rapid pace? Well, one reason is availability of cheap money. Now, what is cheap money? In today's low interest rate environment, when the bank interest rates are slim all around the world, it means that the money available to people with deep pockets is cheap. Why people with deep pockets? We'll cover that in a different video, but for now, you just need to know that cheap money means that you can hire capital or raise loan for not a lot of cost. In our earlier video on how the government and the central bank controls the money supply in the economy, we had discussed in detail how the money actually flows inside the system. I would request you to watch that video once after this, or if you're new to finance as a subject, then you can watch it right now before continuing today's lesson. Now coming back, so when the interest rates are low, or say you'll be getting loan at a low interest rate, it also means that you'll be getting low interest on the money that you invest in government bonds, or bank FDs, or even on the money that you keep in your savings account for that matter. In such a scenario, most people would be looking for other asset classes in order to earn at least inflation-beating returns on their money. And in countries like Japan, where there is negative interest rate, it's a different story altogether. A negative interest rate means that the commercial banks will have to pay to keep their excess cash reserves with the central bank rather than receiving a positive interest income from the central bank for keeping their extra money with them. And in such a scenario, when leaving the money with the bank yields little to no profit, any investment seems to be a good investment, trust me. And this cheap money does reduce the value of the capital as it became available in plenty and increased the demand for good businesses and even just good ideas in some cases. And as economics 101 go, anything which is in high demand also tends to grow in price. This all resulted in the rise of the valuation of most startups, creation of unicorns, and a sudden boom in the entire ecosystem. But nothing lasts forever, and as central banks, especially the Federal Reserve Bank, which is the central bank of the US, which controls the global economy in a way, decides to close taps on buying bonds and eventually raising the cost of the money by increasing the interest rate, then there is an expectation that these startups will start to lose some of their luster. Now you must be thinking, why so? It is because when interest rate rises, loans naturally become more expensive, which also means one can make decent money, if not more, in the short run by buying bonds or even by keeping the money in the bank FDs if the interest rates are as high as it used to be back in 2009. Therefore, in such a condition, venture investing becomes less attractive from a risk to reward perspective, and as with any other commodity, when the price goes up, the demand goes down, which also translates into less money floating around and also less demand to find the next good business idea. So, to sum it all up, as Bill Gurley of Benchmark Capital has said, valuations are at extreme levels because you cannot get a decent return on your money doing anything else. By simple logic, when money is cheap as interest rates are down, it causes investments to rise as we have been witnessing now. But as money becomes expensive and the interest rates go up, investors who use their capital to leverage funds and invest borrowed money are the first ones to shift their investment approach as they suddenly find low-risk investments more appealing with the interest rate rising. Now, does that mean high interest rate will lead to the death of the startup ecosystem? Of course not, but the bargain deals in which the founders get a lot of money for a small piece of their equity will be less likely to happen and less frequently, and the startups will have to work harder to prove that their product is viable. But the positive side to all this is those startups with good and sustainable business model will come out on the top eventually. And that's all for this video. Hope you enjoyed it. If you did, give it a big thumbs up and subscribe to the channel if you've not done it already, and share this video with at least 5 friends of yours and help them enhance their knowledge and become smarter. See you next time. Namaste, bye bye and take care. यार सब्सक्राइबर्स ही नहीं बढ़ रहे हैं यार, क्या करूं?